Hi everyone, it's Chris here again, and today I'm going to provide some additional thoughts and insights into the housing bubble in Australia. So this is a follow-up on my previous video blog post on the housing bubble. Now what I was basically saying in that previous video, just to summarise, is that it's the significant increase in the money supply due to Reserve Bank and government policy that helps create asset bubbles, and in this case the property bubble. Also, government stimulus and spending helps contribute to inflation and therefore price inflation. I also mentioned that an artificial demand is created, that is a demand that wouldn't have otherwise been there if it weren't for this Reserve Bank and government policy. And this helps bid up the price of property. And that's also you have malinvestments created and a misallocation of resources in the economy. And I pointed out that a likely fall in property prices will occur when the pool of real funding significantly declines, as opposed to a tighter monetary policy being embraced by the Reserve Bank of Australia, although the two are usually related. And this contradicts the popular held view that for as long as the Reserve Bank of Australia, or any central bank for that matter, keeps interest rates very low, that property prices will remain relatively buoyant. So moving forward, what also helps contribute to property bubbles, well, government grants do. That's the first home buyers grant, for example, which is funded by the taxpayer either through increased taxes or inflation due to government spending, but that's another topic altogether. And so what you're basically doing is dangling the carrot in front of buyers. It's an added incentive to jump into the market, and people also use this money to contribute towards a deposit, which helps them get approved for a loan. You then also have the speculators, and if you're not invested in property these days in some way, shape or form, then you're kind of looked down upon to some degree. I still think at this point you're probably better off renting, and that it is indeed cheaper. And I think it's a cause for concern whenever you have rental income not covering your mortgage repayments, or especially when there's a big gap between the two. I don't believe in negative gearing. I personally believe in positive cash flow, and that's my basic approach to any investment or any business that I run. I want to have a positive cash flow. I don't want to rely on capital gains. Now, I want to clarify, I'm not denying that people have made a lot of money out of property, and I know they have, and I know some people that have done very well out of property by buying and selling houses, or otherwise known as flipping houses. And armed with the knowledge that I have today, 10 years ago, if I could have flipped some houses and I had the funds to do so, then I would have done it. But I think the bigger problem, as much as it's great that, yeah, some people made some good money, the bigger problem is going to be the bust that's going to come eventually. And I don't think the gains that some people made are worth the bust that we're going to see down the track. Now, I want to mention that property has never been viewed as an investment in the traditional sense of the word investment. If you go back 20, 30 years ago, you didn't have everyone talking about property and investing in property. You didn't have financial advisors and planners and family and friends telling you to invest in property. That's going to be your main source of retirement income, or that it was your ticket to Easy Street. It's never been the case. And one person who addresses this point very well is Austrian economist George Reisman, and this is what he had to say in a previous article, and I quote, "Only decades of inflation and credit expansion could make it possible for people to think of the houses they occupy as an investment. In reality, a house is a consumer good, just like an automobile or a refrigerator. The only difference is that it depreciates more slowly than they do. Only a long string of years in which inflation took place more rapidly than houses depreciated enabled their prices to rise every year and people to come to regard them as a source of financial gain. If not for inflation and the rise in prices that it produces, it would be very clear that housing is a wasting asset. A slowly wasting asset to be sure, but a wasting asset nonetheless." End of quote. So essentially what George Reisman is saying in this article is that if it weren't for inflation, the increase in the supply of money, then creating price inflation, and would we have rising house prices that otherwise would normally fall. So this inflation is masking this depreciation, is what he's saying. Now I want to compare housing to a more traditional form of investment, being stocks. If you own a stock, You're owning a part of a company, a productive asset. And if a company is increasing its net worth through improved productivity, economies of scale, they're employing more people, their asset base is increasing, so therefore their share price is going up. That's a real investment. Hopefully you're getting increased dividends or returns. At least you're getting growth in the share price. And look, I'm not saying that share prices aren't affected by inflation, because they definitely are and have been in the past. You can just look at some of the price to earning ratios, in recent times in the US and abroad in Australia, and it's over the historical average. But the difference between a house and a share in a company is that a company it's a productive asset. A stock is a productive asset. A house isn't, and never has been in the past. Okay, so when you're seeing growth in a company, therefore your share price is generally going to grow. Okay, there's a big difference between the two. I want to also mention that many magazines and analysts will say you can't lose on property. You're going to have 10% gains per year, and that's the trend if you look over the last 10, 15, 20 years. And one magazine I picked up just the other day, Property Investor, they have a graph in here and they say you can't lose a property, increases on average 10% a year, and just look at the graph over the last 30 years. And I think it can be a bit misleading, because they only show the last 30 years, whereas if they show the last 100 years, I don't know if the data goes back that far, but in a lot of markets that I've researched, over the last 100 and 150 years, house prices have only increased with inflation. And this graph actually looks very similar to, coincidentally, to the graph of the growth of money supply in Australia. Okay, which is very interesting. Now, probably the only good thing I got out of this magazine, which I was surprised about, was an article on gold, and that gold's a good protection of your wealth. So yeah, I was surprised by that, but that's a topic we'll leave for later on in another video blog. Now, many people ask me, well, Chris, well, you may be asking, why doesn't the media cover my point of view? Why don't they express my point of view in the media? Well, very simple answer for that. The media has a lot of ties with financial institutions and banks. They're some of the biggest advertising customers. So they're not going to shoot themselves in the foot by promoting my side of the coin. A lot of the analysts and commentators that you see on the news and in TV, although I believe they personally, many of them hold the view in private that there is a housing bubble, they're not going to support my view. They're not going to shoot themselves in the foot. It'd be counterproductive to their industry. So that's the simple explanation for that. Also, many commentators and analysts, they get caught up in the data and the statistics, which can be manipulated, of course. I've seen a few trying to tell us that, look, house prices aren't really that high. It's just a few sections of the market that are inflating the price indexes. Well, the way I'd counter that is by saying that if I want to get an idea for whether house prices are unaffordable, I just need to go to my mortgage broker and work out some repayments on the prices you see of houses in the paper, or just go to your local auction. And that's how I see that it's quite unaffordable compared to historical averages. If I want to see if prices are increasing, for consumer goods, I just need to go to the market. I just need to check out my electricity bills, etc. And that's how I notice that we're experiencing price inflation. I don't need some statistician or some analyst to tell me that, no, it's really not that bad because this is what the data's showing, okay? I think Peter Schiff puts it best when he says, if a weatherman's telling me on TV that it's cloudy outside, I just need to go outside or look out the window, and if it's sunny, I'm not going to believe the weatherman, because I'm going to believe myself. I'm going to believe my own eyes. And I think we need to just use our intuition and not get caught up in too much data in regard to this point that I'm making. Something that people tell me is that, well, Chris, house prices aren't going to drop 30, 40 or 50% because that's never happened before in history. Well, yeah, it's never happened before in history, but in history we've never had house prices increase by as much as they have now. So typically, whenever you have a crash in any asset class or in an economy, the crash is as big as what the boom was. And I believe we'll see that ultimately as well in Australia with the housing market. What will happen when the bust occurs? Well, a lot of people are obviously going to be left stranded. you're going to notice that a lot of people are going to have negative equity, that they owe more than what their house is worth. And this would be largely due to the equity loans they took out to fund renovations, to fund the purchase of new vehicles and plasma TVs. And I saw a lot of this going on when I was working in the finance industry. And I think Warren Buffett puts it well. He had a quote, and I'm just paraphrasing, but he said basically, it's not until the tide comes out that you notice who's been swimming naked. And I think it's a very timely quote, and we're going to see that happening in the near future, over the next few years. Just as a final comment, I want to just talk about the Reserve Bank of Australia and other economists saying that we're experiencing an overheating of the economy, and this is creating inflationary pressures, therefore interest rates have got to rise. Well, I don't believe that it's a strong economic growth and this overheating that's creating price inflation. What indeed is going to create any price inflation, and we've seen it happen in consumer goods and we're seeing it happening in property, it's an increase in the money supply due to the government and Reserve Bank policy. It's not this huge economic growth that we're seeing that's causing price inflation. I don't agree with the cost push demand pull inflation theories. It doesn't make any economic sense, because when a free market's left unhampered and you don't have this inflation occurring, this increase in the money supply, what would happen is, as businesses become more productive, they invest in more efficient capital, in labour, and their output increases, their economies of scale increase, then you have cheaper goods. So this is what happens throughout history. This is why you see, for example, technology products like plasma TVs and VCRs, etc. This is why they fall in price so much, is because their output increases so much, production becomes more efficient, technology improves, therefore the prices fall. And the only reason that inflation doesn't mask this is because the output of these products and efficiency and technological improvements outpaces the inflation. So really, the key point I'm making is that if it weren't for inflation, an increase in the money supply, and therefore creating price inflation, the costs of the goods and services in the economy would generally be falling, okay, and therefore our standards of living would be improving. So yeah, I don't subscribe to this overheating view, and I'll address that in another video blog. But for more information, visit Mises.org to get the Austrian economics point of view perspective on things happening in the economy. I believe it offers the best explanation, and I hope you got something out of this, and I'll speak to you again soon. Bye.